Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. On this weekend show, we're going to start off by talking about the metals sector, recapping this week in trading, and also looking ahead to what is undoubtedly going to be a week full of fireworks next week with the U.S. election, the Fed meeting, and some other international things going on. In the back half of the show, also going to be chatting about the energy sector, trying to make sense of oil's volatility and what some of the underlying stocks, some opportunities in those equities. Just as a reminder, please go back through our website, kereport.com, and podcasts. Just search the KE Report in your podcast player to listen to all our daily editorials and a lot of company interviews from this week. Let's get into the show, and we're kicking it off with Dave Erfle, founder and editor of the Junior Miner Junky. Now, Dave, as the calendar month turned over, we saw a little bit of weakness in the precious metals, also saw a little bit of weakness in the U.S. equity markets, but overall, we continue to see pretty consistent all-time highs. And silver even recently had a breakout, something that we talked about a week and a half ago. Dave, what are you taking away from this, end-of-month correction this week in trading broadly for the precious metals?
Well, yeah, Corey, I mean, it's another month in the books and another record high close for the gold price. And this is despite a strong October rebound in the U.S. dollar of over 4% in Treasury yields. On Wednesday, December gold closed just over 2,800, which was a psychological target. And it was also the day before the last day of the month. So today, on Thursday, you're seeing some technically healthy profit taking during month-end book squaring. And it looks like December gold closed almost $50 lower, but it's still a 4% gain for October.
Well, Dave, when you see the strength of gold on the monthly charts, which is what a lot of funds look at, and you see a little bit more pickup in the media, the financial media, acknowledging the strength of gold, it's kind of hard to ignore because of how it's performed versus other equities. Do you expect more generalists to come possibly into the gold equities just because of the strength of gold lately?
Well, yeah, the World Gold Council came out on Wednesday. I think that was the catalyst that took gold to 2,800 and said that gold demand went up 5% in the third quarter. And that set a record for the period, and it lifted gold consumption above $100 billion for the first time. And we've seen it. We've seen the normally poo-pooing gold Wall Street crowd coming out and having to pay attention to the gold price. I mean, when you have something that's gone up more than the S&P this year, you have to talk about it. So you're seeing, I saw last Friday, you saw Citi Commodities Desk saying this is gold and silver. I've never seen a better environment for the past 10 years. And then BlackRock's analyst came out this week and it was interesting to watch him talk about the merits of gold. And then the interviewer kind of tried to talk him out of it because, the Wall Street hates gold. They've always hated gold. So, when they're forced to talk about it, it's finally starting to get your generalist investor interested. I mean, we had ETF outflows for months and months, despite the gold price breaking out. But recently we've had inflows. So basically, ever since the gold price, went up over 2,500, and that was, the move to 2,500 was driven by central bank demand. And now central banks, since the gold price has gone up so much, they've backed off a little bit, but that slack has been taken up by Western investment demand, which is very bullish. But if you take a look at gold, if you Google gold trends, general investment participation is still nowhere near where it was in the past. So I think there's still more room to go higher. And, next week, we're going to see we've already seen the volatility increase today in gold. And next week, the volatility is going to increase even more when you got the U.S. election, which is the most contentious U.S. election I've ever seen, and what a lot of people are saying it's the most contentious election since the Civil War over 150 years ago. I mean, the mudslinging from both sides, and and the White House gearing up for possible violence, and the polls that have come out saying that people are worried about the violence that might occur next week. And then right after that, a couple days later, you're going to have a Fed decision on November 7th, a day later. Usually the Fed decisions are on Wednesday, but they delayed it because of the election. That's going to be on November 7th. They're expected to lower rates another 25 basis points. That's bullish gold. And then I think it's November 8th, China wraps up a meeting where they're expected to announce a bazooka stimulus package. So next week's going to be super interesting for the gold price.
It will be. But again, these are also just stories. Just look at the chart. The chart is doing well. And as much as we want to say the Western investor isn't in the market, I think they are. They have come into this market, but it's hard to know the extent that they will continue to come in. But the fact of the matter is we have seen good moves in stocks. We've seen good moves in silver. As I've said over the last at least few weeks, that this is right now one of the strongest environments I have seen in well over a decade. Sounds like other mainstream media is also saying that. But then let's look at some of the moves also within the stocks, Dave. We're seeing a major financing window remain open. The high quality companies, boy, oh boy, they just continue to raise money. But also some of the smaller companies are raising money. What stood out to you in terms of financings and the availability of money for companies right now?
Yeah, the capital market financing window really opened wide last week and continued this week. In a couple of juniors that I own and that I cover in my newsletter for my subscribers, Rio 2 Limited announced a 170 million financing package, and Montage Gold announced an $825 million financing package. And then this week, Sante Gold announced a $525 million financing package with the participation of major miner Kinross. And then also last Friday, we saw a couple of strategic placement financings announced, with Kinross taking a percentage of early stage junior Puma exploration, and then Agnico Eagle taken a 13% stake in the Atacama region, Chile region of Atacama, desert region of copper, a huge copper project by Atex Resources. Agnico took a 13-point stake in them. I mean, that's a huge project. It's 15.5 billion pounds of copper and 9 million ounces of gold, and it's still at the PEA stage. So it's, the financing windows has opened up, the mergers and acquisitions. We've had a couple of mergers announced this week, with Bluestone being taken over by RX, I think, and Minera Alamos taken over Sabre Gold. So things are really starting to heat up in the sector, M&A wise, capital markets wise. I mean, ever since the gold price moved over $2,500 an ounce, that's when the M&A sector really started to heat up, when Anglo took the rest of Osisko Mining.
Well, Dave, when you look at the M&A sector heating up even more than it was, I mean, it's really, I would say, been strong all year. I think we've had almost 20 transactions in the sector already. And when you see the capital markets opening up, is it a situation where people are partnering up for the dance? And if some of these bigger companies don't find their dance partner soon, they may get left behind?
Yes. I mean, let's look at the facts. These majors, they've done a great job of shoring up their balance sheets. They're paying healthy dividends. They're doing share buybacks, but they're making all this cash. I mean, did you see Agnico's results today? Another fantastic quarter with all-in sustaining costs of below $1,300 an ounce. I mean, it kind of made up for Newmont's terrible announcement of all-in sustaining costs rising to over $1,600 last week. So these majors now have to concentrate on replacing their ounces. So that's what they're doing. We're starting to see that.
Well, they're also taking out these much more advanced assets too. But Dave, with everything that's going on, M&A that's been going on for a while now, this isn't just a new phenomenon. Financing's trickling down into even some of the smaller companies. What stage do you put this bull market at? Because I think we always do need to be aware, when everything seems the rosiest, sometimes that can signify end of cycle behavior.
Well, as far as sentiment's concerned, it's still in the very early stages. I mean, that's what really drives the junior sector is sentiment even more than the mining sector. So, if we look at the GDX, it's still 30% lower than the peak it hit in 2011 when the gold price was about $1,000 lower. So, I mean, the gold price was around $1,800 when GDX peaked at 60 in 2011. And like I said, it's 30% lower. But if you look at the GDXJ, it peaked at 127 back then, and it's 65% lower. So there's still a lot of catching up to do with not only the miners, but especially the juniors. So, I mean, we're still in the very early stages here.
Dave, we were talking a little bit off mic about the moves in GDX and GDXJ, maybe not really reflecting just how well some of the mid tiers have done, or even some of the smaller producers have done, because you have some bigger laggards in there, like the Newmonts and Barricks, that are kind of dragging it down a little bit. When you've seen other companies that are kind of the smaller majors and then some of the mid tiers really killing it lately, the last couple quarters, do you think GDX almost paints an unfair picture of actually what's happening under the surface in the sector?
Oh, absolutely. I mean, when you have a company like Newmont who's still trying to process the Newcrest merger by getting rid of higher cost mines that they deem tier two, I mean, they're 12.5%. They make up 12.5% of the GDX. So, when they announce that quarter, not only is it a bellwether for the sector when investors see that their costs have risen so much, but it's also 12.5% of the GDX. So it took GDX down a lot further than GDXJ, but nevertheless, I mean, GDXJ and SIL and SILJ, the silver ETFs, they've been outperforming GDX ever since August. So that is bullish when you see these higher risk ETFs outperforming the lower risk global miner ETF GDX. So yeah, I mean, it's really a shame when you have a company like Newmont come out and they still had a really good quarter, but it's those costs rising from, I think, almost $150, $175 higher is what really spooked investors.
But Dave, I think this is an interesting topic where this catch-up trade or the underperformance of the stocks, it really depends what you look at. And you guys are right. You look at GDX and yeah, it looks like there is a huge catch-up trade. But you also look at the good companies and man, those ones are at all-time highs and they just keep on moving. They actually have leveraged the gold price. So do we still need a catch-up trade with, I guess, the lower quality companies, or do we even have a historical reference for a catch-up trade? Have we ever seen this discrepancy, if you want to make that argument?
No, I've never seen this discrepancy last so long in the sector. I've been in it, over 20 years now. I mean, during the last bull market from 2001 to 2011, it lasted like a decade. I mean, you had participation in the juniors even more so than in the majors. I mean, my credo back then was I don't want to invest in majors because they don't provide the leverage that the juniors do. And now in this cycle, it's pretty much flipped. I mean, we've had the miners and the royalty companies making good money and performing really well, and like you said, some of them performing in line with the gold price for the past few years. Yet it's only been a handful of juniors that have been bifurcating from the sector up until recently. We've seen more and more juniors outperform lately, but still, there's still a lot of juniors that are still wallowing down there below where they began the year at, that are still being sold for tax loss. So yeah, we've still yet to see that dart throwers move that we usually have. When finance window opens and gold breaks out. So we haven't even come close to a move like that yet.
Well, Dave, one historical analog we could look back to is the 1970s. And in the 1970s, in the middle of the decade, the gold stocks actually sold down to sideways to down for years, I think 4 or 5 years. And it wasn't until 1978 through 1979 and really pushing into 1980, so really 18 months or so, that out of nowhere, stocks like Hecla or Newmont just shot incredibly higher and went up, 4x, 5x, 10x. Is it possible that we've set the early stage where some of the royalty companies and the biggest producers have done well, some of the most advanced developers that are probably takeout targets have done well, but the rest of the sector really hasn't moved that much? Could we have that 1978 to 1980 move in the space where there is still a giant kind of blow off top phase left to this bull market, but we're just not there yet, and maybe some investors are getting impatient right before that happens?
Yes, I mean, that's usually what happens. I mean, investors get impatient and then they finally sell right before it takes off. I mean, also I can also like to add to what happened in the 70s after the gold price had that spike peak when I think it hit $875 on the second or third week of January 1980. The gold price started to correct because it was a spike high, and okay, this is it. This is a blow off top, but the miners continued to do really well for the next year and a half because they hadn't had a chance to catch up to the gold price doing so well and doing so and helping their bottom line, especially in companies that had a lot of gold in the ground. Like now, I mean, there's so many of these optionality companies that have got a lot of gold in the ground that have yet that are still wallowing at their lows because of several factors. Maybe management did not raise money at the right time. They mismanaged capital markets, and they were maybe due to market conditions, they were forced to over dilute at a lower share price than they expected and add full warrants that also limits the upside in the stock. So investors right now are getting impatient. It's tax loss selling season. So they're going to sell these stocks that are still lower than they were at the beginning of the year for tax loss. And maybe they'll get back into them next year if the gold price has reached 3,000 by then, which I expect it to. I mean, I still have a target of $3,000 gold by Q1 of 2025.
So, Dave, 3,000 gold is, let's just round it off to say 3 times what gold was about 9 years ago. We want to make the reference to the 70s. In about 10 years' time, throughout the 70s, gold went up more than 10 times. If you want to take that spike high, way more than 10 times, does that mean gold still has multiples to tack on? 3,000 is just a stopping point to what, 5,000, 10,000 even?
Well, I like to be a little more pragmatic about my predictions as far as the gold price is concerned.
But just historical references to the
so
70s, though.
Yeah, I mean, it could very well do that. But I tell you the truth, I mean, I don't know what the world's going to look like if gold's at $10,000 an ounce. I think there's going to be a lot more chaos in the world if gold's at $10,000.
Well, Dave, didn't we hear the exact same thing about I don't want to live in a world if there's $2,000 gold? I distinctly remember interviews and written pieces where people said, I don't want to live in a world where there's 2,000 gold. And we're in it. We're in 2,800 gold. So is it possible that gold could go higher than people think just because everything else is inflating up?
Well, back during the last bull market, 2,000 was a realistic target. So now, the gold price is over 3 times less than $10,000 an ounce. But as far as the debt situation is concerned, look, if you take a look at the debt ceiling and the U.S. debt, the gold price has pretty much mirrored the continued rising of the debt ceiling. And now there isn't even a debt ceiling right now. And it just keeps going higher. So, I'm just waiting for the day when, like we talked about earlier, that a lot of these juniors finally start playing catch up to where the gold price is. I mean, if you take a look at where some of these juniors that have multi-millions of ounces in the ground right now, most of them are trading at less than $50 an ounce. And some of them are in later stages. They're at the finance stage, or they're waiting for permits or what have you. And they're trading at less than $50 an ounce in the ground. Yet in 2010, 2011, when the gold price was $1,000 lower, companies were being taken out for over $1,000 an ounce in the ground. So I'm not saying that's going to happen again anytime soon, where they're going to be taken out for $1,000 an ounce on the ground. But I'd be happy with the average going up to $150, $200 right now. Then a lot of my stocks would be doing very well if that took place.
Oh, absolutely. But let's see. Hey, the market does dictate that price, and it is a slightly different environment still than that last end to the bull market in 2011 when, companies were buying everything. We're not seeing that right now. Companies are still being very selective. Now, Dave, you did outline what's coming next week with all the volatility. What moves are you expecting in the gold price then? What are key levels we need to watch? And even more importantly, what would, I guess, encourage you to the upside? What would scare you to the downside?
Well, if you take a look at the gold chart, the 50-day moving average has been pretty good support ever since July. And it's at right around 2640 right now, 2645. And the gold price is what, 2750. So a test of that would not be out of the question. but I wouldn't want to see the gold price go any lower than its 18-week moving average, which is around 2570 right now. That's been strong support going back even farther. So I wouldn't like to see the gold price go below, let's say 2550, but that's a long way from where it is right now, and I don't see a catalyst on the horizon to get it down there.
Well, Dave, let's also talk about silver because obviously silver had a great week last week, popped up to 35, broke that 3250 resistance level that had been there in place for a while, and now it's kind of pulled back to that same level where the breakout happened. So the gap up, we're filling the gap. What do you make of where silver is today, and how do you think the news next week could affect something that's a hybrid metal like silver?
Yeah, I mean, silver's been doing really well ever since gold had that monthly close above 2,500. And recently it tested its technical target of $35. I mean, silver tends to underperform gold in the initial phase of precious metals bull markets, and then it outperforms gold during the more developed stage. I mean, in the previous bull market, silver saw gains of over 1,000% over previous lows when it established the current all-time high at $50 an ounce in April of 2011. I mean, silver tested that resistance at $35 2 weeks ago, and it's up over 40% this year. That's even more than gold. I think gold's up 33% this year, and the next resistance level is $38. So we've had a recent shakeout of short, medium-term bullish positions in the $32 to $35 range. I mean, 32.50 was really strong resistance for a long time, and we finally broke above there, and we gapped up and broke above there on a major short covering move. So I wanted to see that gap close sooner rather than later, and I got my wish. And now we've had that 32.50 level back tested today. I think it got to 32.65. So I think this shift is setting the stage for silver to target a new all-time high, potentially surpassing that $50. And if gold gets to my 3,000 target by Q1 of next year, then I think silver has a chance of getting to 50 or higher.
Does that mean you're loading up on silver stocks, Dave? That sounds like a perfect environment for pretty much every silver stock.
Oh, I already have. I've been loading up on silver stocks since the beginning of the year, expecting in anticipation of this move. So, I mean, and silver stocks, some of them are even more undervalued than gold stocks. But in silver stocks, there's a lot less quality silver stocks out there than there are gold juniors. So I've got a basket of them in the portfolio and several of them in my top 10 list.
Just to that point about portfolio construction, do you ever get to the point where you would weight something like a quality silver stock higher than a gold stock just because it may have more torque and there are so few to choose from?
Oh, yes, absolutely. My number one pick in my top 10 is a silver junior.
Well, Dave, I know you're not going to share that stock with us, but you did share a couple stocks with me last week. But look, overall, financing.
This week too.
This week too, that's fair. Yeah, some of the financings and some of that M&A. Look, everything does seem to be lining up continuously for the precious metals. That uptrend is continuing. Yes, a bit of a pullback here. Really, GDX right back to the 50-day moving average. So as long as this uptrend continues, man, oh man, this market could just keep on running. Seems to be running side by side with a lot of other markets too, but that is not a bad thing. Dave Erfle, founder and editor of the Junior Miner Junky. Dave, always a pleasure chatting with you. Thanks for taking time with us on this weekend show.
Thanks, guys. Thanks for having me on the Weekend Update.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, shifting our focus to the energy sector as we are now chatting with Dan Steffens, president of the Energy Prospectus Group. Click the link in the show notes to visit the Energy Prospectus Group website and follow along with Dan's analysis of the oil and natural gas sector, as well as all the companies he follows and the different portfolios he puts them in with all his subscribers. Dan does a great job of sharing his models and outlook on so many energy companies. I guarantee you sign up for the Energy Prospectus Group, you'll learn a lot about individual companies and figure out which ones fit in your portfolio. Dan, you shared a couple companies with us that we'll get to at the tail end of this interview that, interestingly, don't really have direct exposure to oil and gas prices. That ties into this initial conversation on the oil and natural gas prices because largely they're under pressure, especially the oil price. As we're recording this on Tuesday, oil is around $67 a barrel. It got hit very hard on Monday, and that's a move I want to talk to you about because, look, we had Israel attacking Iran, and the oil price went down by almost $5 that day. The argument being that they didn't attack any oil facilities, but look, war in these areas that are large oil producers, you would think it would cause a spike in the oil price. It went the other way. Dan, make sense of that for me, please.
Yeah, it doesn't really make sense. The belief is it came out, after the attacks were on Sunday, so it was when the market was closed. And then when the traders could get to their position, they start, selling off their futures contracts on before the market opened on Monday. So when it opened, it was down, and then when it's down, then it triggers a lot of computer-generated trades based on algorithms and margin calls or whatever on the funds that are long oil, and that created the thing. But it knocked the price from like 72 down $5 to like 67, and 67 is a strong support level, technically support level, and it has bounced off that 3 times recently. If anybody goes out and runs a 1-year chart of West Texas Intermediate, you're going to see that there's been 3 previous dips below 67, and it almost within a few days it bounced back and then moved back above $70 oil. I'm basing all my current forecast for the fourth quarter on WTI averaging $70 for the quarter, which it's been above 70 most of the, so far this in the quarter. We're just at the end of the first month, but it would have to stay, at 67 or that if for quite a while before it would mean the average would be below 70. Now, this one thing, I think there's some paradigms that have to be addressed. Number one is just because Israel's attacks were somewhat limited to military strikes, does it mean peace suddenly has broken out in the Middle East? I mean, you still have Hezbollah and Hamas and other Iranian proxies are attacking Israel like crazy, and I think they're committed to basically wiping out Hezbollah before they talk about any peace agreement or anything. And, sooner or later, that's got to happen. And also, the other paradigm is that U.S. producers could run up production very fast. If Trump wins the election, becomes a president, he'll be, reinstall this drill baby drill mentality. But the industry is much different today than it was when Trump was in the presidency the last time. That was at the very early innings of the U.S. shale boom. They were just then drilling like crazy, drilling out to hold acreage and putting a lot of high rate wells online. Now that we're more and more dependent on these high decline rate horizontal shale wells, you have to spend more and more capital and drill more and more wells every year just to hold production flat. And U.S. production is down several 100,000 barrels a day from where it was in December. And if you added up the first 7 months through July, you would see the average for the first 7 months is below what production was. Now, in total, year over year, yes, U.S. production will be up based on the total production for 2023, but it doesn't have much chance of going any higher unless there's a significant increase in the drilling budgets of these upstream companies, and I don't see that happening. They are committed to live within cash flow, pay dividends, and everything. So that's it. I don't see it happening.
Well, Dan, you brought up some good points there. I think that the oil market, more than any other commodity, is a market of news, noise, and narratives. I mean, there are so many. Like you brought up, the Trump is going to drill, baby, drill. It's going to increase production. If the Harris administration wins, they're going to shut it in and prices are going to spike. China is about ready to fall apart as an economy, and they're not going to have enough demand. The U.S. isn't going to have a demand if it slips into recession. OPEC is going to pressure the North American producers by producing like crazy. There's so much noise. How do investors cut through all the narratives, all the noise? Because the reality is when you look at the price action, it's been stuck in a range despite geopolitics or all these other ideas about what's going to happen. How do we make sense of a realistic oil price target based on how you analyze the markets, Dan?
Yeah, the thing, I think, to get the upstream companies to increase their drilling budgets, spend more money to develop more reserves and increase U.S. production, you're going to have an oil price that's up near 80 again, and the visibility that it's going to be able to stay there. The one thing with the backwardation in the futures contract, because futures outprice, companies cannot hedge and even lock in today's price for a year, because they would lock in lower prices than the price today. So another thing to remember is the OPEC countries have national oil companies. They do what the kings and queens and king and presidents, whatever of those countries, tell them to do. In the United States, all oil field development is by private entities. I mean, they may be publicly traded, but they're not controlled by the government. And so unless there was a lot of incentive, somehow much lower taxes to go out and spend more money in the oil field or something, I just don't see that it's going to ramp up U.S. production or anywhere really outside of OPEC is going to ramp up. And remember, I mean, the war between Ukraine and Russia has done significant damage to Russia's ability to, ramp up production. It hasn't gone down very much, but it's going to be tough for them without, a lot more capital invested to ramp up their production also.
So, Dan, what if we just see the U.S. stay where it is production-wise, which is pretty close to all-time highs? It was recently at all-time production highs, and it really skyrocketed from 2010 up into this time. OPEC, yes, they're cutting some production, but that hasn't seemed to impact markets. If we keep at this current production rate, doesn't that mean that we could still have maybe a bit of pressure under oil?
Well, I mean, oil demand's going to go up, not as fast as it was, but EIA, IEA, OPEC, all these, entities are projecting increasing demand year after year. And historically, it's going to go up by 1 million barrels a day, 1.5 million barrels a day. Now, we did have kind of a surge in demand because, remember, it was being compared to the pandemic years. So, it's grown. Well, now we've kind of gotten back to the historic trend for demand of 1 million to 1.5 million barrels per day of increased demand. Now, so for oil demand to go down, that would mean the world's population is either going down and people are willing to accept much lower standard of living, or you're just going to have this very serious global recession that would lower demand. But right now, I don't see it happening. And even China, I mean, their demand is up. It's not increasing as fast as it was, but it's still increasing. And, I think one of the biggest problems we have right now is this election we don't know. And people believe Trump's going to do one thing or Harris is going to do something else that's going to impact, oil supply one way or the other. We don't have a national oil company, so there's really nothing they can do directly to do it. So they would have to convince the upstream companies to go out and raise their drilling budgets. That would be the only way you get a big increase in non-OPEC production.
Well, Dan, before we dive into the individual companies you have outlined for us this time, just a general comment on, it seems like the energy equities have been more resilient to price drops than maybe what we would see in other commodities. And some people postulate that's because they either believe oil prices are going to go back higher again, or that these prices are pretty sticky and that they'll be able to protect their dividends, protect their production forecasts. And what do you think about the resilience of the energy stocks as a group?
Well, one thing, because they survived the period of, the pandemic, so 2020, 21, and 22, oil prices were much lower than they are today, and these companies survived and they're thriving. They're doing very well at 67 or 65 or whatever the oil price is. unless it goes back below 50, they're very profitable companies. And the one thing, we're kind of in this information void right now. I mean, we're recording this the last couple of days of October, so only a handful of companies, only one of our Sweet 16 companies, Matador Resources, reported third quarter results. Their third quarter results just crushed my forecast. They crushed everybody's forecast. Their production was higher, their realized prices were higher, and it looks really good. And they raised their production forecast because they are a very aggressive upstream company, Matador, MTDR, if anybody wants to look at it. It increased, their third quarter results increased my valuation on the stock by $4 to $84 a share, and I think it's trading at like 51 or something today. So I think it's got a lot of upside. And I expect all of our Sweet 16 companies, that's my top flagship portfolio, I expect them to report third quarter results that actually beat my forecast, because actual realized oil and gas prices for the quarter are probably slightly higher than I used in my forecast.
Well, and that's a key point, is that these companies, these oil companies, are still doing well at these current prices. And look, they're still investing in growth. I was at an energy conference recently focused on Canadian companies, and a lot of them still saying, yes, look, we're returning money to shareholders and we're also investing in growth. So that continues to be the narrative, and these companies still continue to do well. But as you said, we can't have an oil price that drops into the low 50s or even below. Let's get into some of the companies then. As I mentioned, these companies that you sent over, no direct exposure to oil and gas prices. The first one being Solaris Energy Infrastructure, traded S.E.I. This is a smaller company for the oil space, a market cap of just over 500 million, small dividend yield of 3.6%. Stock is up quite a bit this year, though, about 70%. So we need to factor that in. Give us an overview of Solaris Energy Infrastructure, please.
Okay, Solaris Energy Infrastructure, which used to be called Solaris Oilfield Infrastructure, is a significantly different company than it was. It just closed a merger on September the 11th for the acquisition or merger of a private company, Mobile Energy Rentals. It's a private company, so they use a symbol MER, but not that. So that merged into Solaris S.O.I., and then they changed their name to Solaris Energy Infrastructure to better reflect the new company that they are. Now, Solaris Energy Infrastructure is a highly respected kind of engineering firm that came up with the very best pieces of equipment and methods to control frac sand at the during the completion of these wells. And some of these 2-mile long laterals and stuff require 100 train cars full of sand to complete them. And so during the pandemic, they gained market share. They're like number one in the handling of frac sand at the well site, and they're a very profitable company. But Mobile Energy Rentals, a totally different company, but they provide and build independent power plants that are natural gas-fired power plants where they're taking the natural gas right out of the ground. They have to clean it up, get the water out of it, it's just turn it into pure gas, and then they can put it into these modular, right-sized power plants. And the need for that, in addition to some of the upstream companies doing it, Riley Exploration Permian is now producing 100% of their electricity that they need in the field from the gas coming out of the ground, and they're selling their excess electricity into the grid. I know Diamondback's looking at it. Several of the other companies are looking at it. And I think the reason I'm recommending it, they have not reported exactly where they stand and with their forecast yet. And that's going to come out next week. On November the 4th, they're going to announce third quarter results, and there will be a lot of slides in their presentation on what the new company looks like. Now, remember, this is how you invest in this big demand for electricity for AI data centers and for crypto Bitcoin mining and stuff like that. This is a good way to invest in it. And this is a very profitable company. And I think when the Wall Street gang, the Wall Street analysts get a much better picture and are able to forecast what this thing's going to look like in 2025 and 2026, they're going to raise their price targets. So it's trading at around $13, slightly over $13 this morning on Tuesday. And I think it could go to $20, which would be another like 50 or 70% over where it's trading right now. And it pays a nice dividend already. So not a great dividend. I mean, it's about 3.6% based on today's share price, but they have every indication they're going to increase their dividends once everything stabilizes again and they get these increased revenues.
Well, Dan, we've talked about this kind of idea before in previous mergers, but it seems like you like to be in early, right after the merger has been announced, because the market hasn't really digested the pro forma company. They don't have quarters and quarters of information yet as to what the pro forma company is going to look like. So do you think this is a sweet spot even within the sector just to be able to pick off some of these mergers before they're, I guess, followed by as many analysts and before they're better understood, that maybe you're going to get an edge as an investor?
Yeah, well, and this is a totally different kind of company. This is not like two upstream companies that are doing exactly the same thing, merging. They get some synergies by, combining their back office and all that. This has actually created a whole different kind of service company. Not only is it an oil field service company, it's also going to be serving the needs of the AI companies and stuff. And I think you're going to see that they got like a backlog of $200 million of orders already for these new power plants. And that's just through like the third quarter of next year. And like I said, Solaris Oilfield Infrastructure was, and Solaris Energy Infrastructure is, a highly respected engineering firm. They do a lot of work for the companies that I follow already. And I know a lot of the companies because in the Permian Basin, because they're pipeline constrained out there and bottlenecked, the gas prices are ridiculously low. I mean, a lot of those companies are paying people to take their gas so they can produce the oil, and hardly any of the upstream companies in the Delaware Basin, which is the western half of the Permian, are getting more than $1 for their gas. So they would rather use it if they can just generate their own electricity, because oil field pumps require a lot of electricity to run 24/7. That will lower their operating expenses. But if they can then start selling excess power into the grid, that creates another profit center that doesn't exist today. So I just really like the business plan of the company. It's a very low profile company. I've been trying to get them to host webinars for us and luncheons for us, and I haven't been able to get. But this is typical when these companies are run by engineers or geologists, scientific people. They don't really quite understand that they need to get out and sell their story to the market more. But I think there's going to be a lot of interest in this company.
Yeah, they think that the numbers will speak for themselves, and hey, maybe they will, because I'm looking over your report, and yes, you noted the significant revenue growth, but you also have some forecasts for net income really exploding from where it is. 2023 net income was about $24 million, operating cash flow about $3.18 a share. What can you share with us, or what do you want to share with our listeners in terms of the net income growth that you see this company having a few years out?
Well, just between the third quarter and the fourth quarter, they should be reporting a big increase in revenues and bottom line, because this deal is immediately accretive to their revenues, net income, and operating cash flow. But then you look forward into a full year of the new company, and we're looking at a tripling of the net income and doubling at least, because they did issue some shares. The deal was a cash plus stock deal, and the ownership of MER now owns like 27% of the new company. So they did issue some new shares. So the net income per share, I believe, is going to more than double next year over year, and cash flow is going to like $4 a share. And this company, I mean, that would mean it's trading for about 3 times cash flow, and it's got a pristine balance sheet, pays a dividend. It has no, needs to go into the debt market much to do anything. So they can fund their growth with operating cash flow. And I do think they will start raising their dividends. So of the two companies I'm talking about, because Plains is the next one I want to talk about, this one I believe has more upside in the share price, but it does pay a small dividend. I'm just throwing that out there. So it's a classic growth plus income stock, I believe.
Well, Dan, I appreciate you breaking that down for us. And it does look like an interesting business model to kind of merge the oil services business with this energy component and possibly new revenue streams, like you mentioned. So it'll be fascinating to follow along. But let's get into the next one. Plains All American Pipeline LP, traded on the NYSE under the ticker PAA. Now, this is a midstream, I would say these are like the picks and shovels of the oil industry. They're, the pipeline companies. This is an MLP. It can actually do well even in a stagnant oil price because there's so much demand for pipeline. Walk us through the value drivers you see for Plains All American Pipeline.
Yeah, and I've been following this company for decades, really, since we started Energy Prospectus Group. It's a highly respected midstream company, one of the biggest midstream companies. A lot of the oil being produced in the Permian Basin goes through their pipes and their storage facilities and stuff like that. So they push a lot of liquids. And prior to the pandemic, they had committed to a lot of capital growth projects. So they were spending a lot of money in 2018, 2019, and 2020 to build out their big pipeline network, whatever you want to call it. If you look a map of their pipelines, it goes all the way up into Canada and covers most of the middle of the country. And another thing, they have already promised the market that they're going to increase their dividends for several years, because until they get up to like 60% of their distributed cash flow, and they're well below that right now. So they have the room within their free cash flow generation to increase these dividends now. And I think they're going to announce very soon about a 15-cent increase in their dividend. And I think that's why, again, this is a much different company than Solaris, much larger company. Now, we recommend, PAA, which is Plains All American Pipeline LP, that LP is limited partnership. It is traded in what is called a master limited partnership. So if you buy into PAA, you're not buying really shares, you're buying units in the partnership, which are kind of the same thing as stock. But they pay out quarterly dividends. But then also their general partner, whose only asset is really their investment in Plains AA, pays an identical dividend. They pay exactly the same dividends, but it has elected to be taxed as a C Corp. It is also a partnership, but it has elected to be taxed as a corporation. So those dividends are just regular dividends, fully taxable, but they are more appropriate for an IRA account. I know some people don't like investing in MLPs because you have to wait to get their annual K1 to finish your tax return. But anyway, I take the time. They got a lot of good slides and presentation on their website to learn about it. But again, I'm really recommending this because I know they are going to, and they've done it before. See, they cut their dividends way back pre-pandemic because they announced in the market, we're going to use this capital from paying lower dividends to build out our asset base. And they did it, and they're done now. So those capital commitments are behind them now. So now they generate a lot more free cash flow.
So Dan, on a pipeline company like this, a midstreamer, when they have spent the money to build out the pipelines, like you said they just did, do they simply benefit from more U.S. production so that those pipes are full?
Yes, as long as their pipes are full, and their pipes are full. I mean, the Permian Basin doesn't really have enough pipelines, especially for natural gas and NGLs. So there's still upside for more growth, but as long as those pipelines stay full, they're just taking tolls. They're toll takers. And so those investments are all made, big capital investments to build them up front, but then they're like 30, 40-year assets. As long as you maintain them, they last forever. So they're just cash flow machines, and they're really good for long-term investors that want a nice dividend. And their dividend yield is over 7% right now. So it's a real good dividend. And I think there's upside in the share price to go to like 21. My current valuation is 21, and first call's price target is 20. So there's still room to get up to that new price target. And I think they'll be raising their price target as the company raises its dividends.
Okay. Hey, Dan, very interesting. Thanks for stepping away from simply the oil and gas companies, the production companies, to talk about some of these midstreamers, some of these other companies that aren't so exposed to that price, because, look, we're getting differing opinions on where the oil and natural gas prices are going. So if you still want to be invested in the sector, look to some of these other companies that don't have that exposure to underlying prices. Again, Dan Steffens, president of the Energy Prospectus Group. Click that link in the show notes. Dan, thanks for joining us on this weekend show. And everyone, thanks for tuning in to the weekend edition of the KE Report. Be sure to go back through our website, kereport.com, and podcast. Just search the KE Report on your podcast player, where you can then listen to all our daily editorials and a lot of company updates that we have been posting. Everyone, please keep in touch with us, and I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.